Central Bank Digital Currencies, or CBDCs, are digital versions of a country's fiat currency. They are issued and backed by the nation's central bank. Think of it like a digital banknote. You can use it to pay for goods and services just like physical cash, but it exists purely in electronic form. CBDCs are different from cryptocurrencies like Bitcoin. Cryptocurrencies are decentralized, meaning no single entity controls them. In contrast, CBDCs are centralized and controlled by the issuing central bank. This makes CBDCs a direct claim on the central bank, similar to physical cash. The concept of CBDCs has gained significant traction in recent years. Countries around the world are researching and, in some cases, piloting their own CBDCs. The potential benefits and drawbacks are being hotly debated. The rise of digital payments and the decline of cash usage have further fueled interest in CBDCs. They are seen as a way to modernize financial systems and make them more efficient. However, there are also concerns about the potential impact on privacy, security, and the role of traditional banks. One of the most touted benefits of CBDCs is their potential to make transactions faster and cheaper. Currently, cross-border payments can take days to process and involve hefty fees. CBDCs could streamline this process, making it almost instantaneous and significantly reducing costs. Think about sending money to a family member overseas. With CBDCs, this transaction could potentially happen in seconds with minimal fees. This could be a game changer for remittances, which are a lifeline for many people in developing countries. Moreover, CBDCs could reduce the cost of domestic payments as well. Businesses could benefit from lower transaction fees, which could be passed on to consumers in the form of lower prices. This increased efficiency could boost economic activity and promote financial inclusion. However, it's important to note that the actual speed and cost savings of CBDC transactions will depend on how they are designed and implemented. Factors such as the underlying technology and the level of interoperability with existing payment systems will play a crucial role. CBDCs have the potential to promote financial inclusion by providing access to financial services for the unbanked population. In many developing countries, a significant portion of the population lacks access to traditional banking services. This can exclude them from participating fully in the economy. With CBDCs, individuals could potentially open digital wallets directly with the central bank, even without having a bank account. This would give them access to basic financial services such as making payments, receiving transfers, and saving money securely. Moreover, CBDCs could facilitate the distribution of government benefits and aid payments. By directly transferring funds to individuals' digital wallets, governments could ensure that aid reaches the intended recipients quickly and efficiently, reducing the risk of fraud and corruption. However, achieving financial inclusion through CBDCs requires addressing several challenges. These include ensuring access to digital devices and internet connectivity, as well as providing financial literacy programs to educate people on how to use CBDCs safely and effectively. The introduction of CBDCs could accelerate the transition towards a cashless society. As the use of physical cash declines, central banks are exploring ways to ensure the continued availability of central bank money in digital form. CBDCs could fill this gap and provide a digital alternative to cash. A cashless society could offer several advantages, including reduced crime rates, lower costs associated with handling and transporting cash, and increased transparency in transactions. It could also make it easier for governments to track and collect taxes. However, a cashless society also raises concerns about privacy and the potential for financial exclusion of vulnerable groups who may not have access to digital payment methods. It's crucial to strike a balance between promoting innovation and ensuring that everyone has access to essential financial services. The move towards a cashless society is already underway, driven by the increasing popularity of digital payment methods. CBDCs could further accelerate this trend, but it's important to carefully consider the potential implications and ensure a smooth transition. Section 5. Enhanced monetary policy control. CBDCs could provide central banks with more tools to implement monetary policy effectively. For instance, central banks could use CBDCs to implement negative interest rates more directly. This could be useful in stimulating the economy during times of low inflation or recession. Furthermore, CBDCs could enable more targeted monetary policy interventions. Central banks could distribute funds directly to specific sectors or demographics, providing a more efficient way to stimulate economic activity or address inequalities. The use of CBDCs could also enhance the speed and efficiency of monetary policy transmission. With traditional monetary policy tools, there can be lags between the implementation of a policy and its impact on the real economy. CBDCs could potentially reduce these lags, making monetary policy more responsive. However, the use of CBDCs for monetary policy purposes also raises concerns about potential unintended consequences and the need for careful calibration to avoid disruptions to financial markets and the broader economy. Section 6. Navigating the privacy concerns surrounding CBDCs. One of the most significant concerns surrounding CBDCs is the potential impact on privacy. With a CBDC, the central bank could have access to a record of every transaction made using the digital currency. This raises concerns about government surveillance and the potential for misuse of personal data. Critics argue that CBDCs could give governments an unprecedented level of control over citizens' financial transactions. They fear that governments could use this power to track spending habits, censor transactions they disagree with, or even freeze the assets of individuals or entities. To address these concerns, policymakers need to prioritize privacy in the design and implementation of CBDCs. This could involve implementing strong data protection measures, limiting the amount of data collected by the central bank, and ensuring transparency and accountability in how transaction data is used. Balancing the benefits of CBDCs with the need to protect individual privacy is crucial for their successful adoption. Striking the right balance will require careful consideration of the trade-offs involved and ongoing dialogue between policymakers, technologists, and privacy advocates. Section 7. Cybersecurity risks in CBDCs. A looming threat? The digital nature of CBDCs makes them potentially vulnerable to cybersecurity risks. A successful cyber attack on a CBDC system could have severe consequences, disrupting financial transactions, causing financial losses, and undermining trust in the entire system. Hackers and cybercriminals could target CBDC infrastructure to steal funds, disrupt transactions, or manipulate data. The interconnected nature of financial systems means that a breach in one part of the system could have cascading effects throughout the entire financial ecosystem. To mitigate these risks, robust cybersecurity measures are essential. This includes implementing strong authentication and authorization mechanisms, secure storage solutions for digital wallets, and continuous monitoring and threat intelligence to detect and respond to potential attacks. Building a secure and resilient CBDC infrastructure is paramount to ensuring the stability and trustworthiness of the system. Central banks need to invest heavily in cybersecurity expertise and collaborate with technology providers and other stakeholders to stay ahead of evolving threats. Section 8. The potential for bank disintermediation. The introduction of CBDCs could potentially disrupt the traditional banking system by leading to bank disintermediation. If individuals and businesses choose to hold significant amounts of CBDCs instead of bank deposits, it could reduce the funds available to banks for lending and other financial services. This could have significant implications for the banking sector, potentially leading to lower profitability, consolidation in the industry, and a reduced role for banks in the financial system. Banks would need to adapt their business models to remain competitive in a CBDC-driven environment. However, some experts argue that CBDCs could also present opportunities for banks to innovate and offer new services. For instance, banks could leverage their existing infrastructure and customer relationships to provide value-added services on top of CBDC accounts, such as financial management tools or lending products. The impact of CBDCs on the banking sector will depend on various factors, including the design of the CBDC system, the level of adoption by individuals and businesses, and the strategic responses of banks. Section 9. Increased government control. A valid concern? Another concern raised by critics of CBDCs is the potential for increased government control over the economy and individuals' financial lives. With a CBDC, the government could potentially have more visibility into citizens' spending habits and greater ability to influence economic activity. For example, governments could use CBDCs to implement targeted spending programs, offering incentives for certain types of purchases or restricting spending on specific goods or services. While this could be used for legitimate policy objectives, it also raises concerns about potential overreach and the erosion of individual freedoms. Furthermore, some worry that governments could use CBDCs to censor transactions or freeze assets for political reasons. This could have a chilling effect on free speech and dissent, undermining fundamental democratic values. It's crucial to establish clear legal frameworks and safeguards to prevent the misuse of CBDCs for political purposes. Transparency, accountability, and independent oversight are essential to ensure that CBDCs are used responsibly and ethically. Section 10. The road ahead. Key considerations for CBDC implementation. As central banks around the world explore the potential of CBDCs, several key considerations need to be addressed to ensure their successful implementation. Privacy protection. Robust privacy-enhancing technologies and regulations are essential to protect individual privacy and prevent government surveillance. Data minimization, anonymization techniques, and clear rules governing data access and use are crucial. Adoption and phasing, gradual rollout and phased implementation can help manage risks and allow for adjustments based on real-world experience. Piloting CBDCs in controlled environments and engaging with stakeholders throughout the process is essential. Cybersecurity measures. Investing in state-of-the-art cybersecurity infrastructure and expertise is paramount to safeguarding CBDC systems from cyber attacks. Regular security audits, penetration testing, and incident response planning are crucial to mitigate risks. Impact on traditional banking. Policymakers need to carefully consider the potential impact of CBDCs on the banking sector and take steps to mitigate risks of disintermediation. This may involve exploring partnerships between central banks and commercial banks, or adjusting regulations to ensure a level playing field. International cooperation, cross-border interoperability of CBDC systems is crucial for realizing their full potential. International cooperation and standardization efforts are needed to address technical, legal, and regulatory challenges. Section 11, Conclusion. CBDCs, a transformative technology with challenges. Central Bank Digital Currencies, or CBDCs, represent a potentially transformative technology with the potential to revolutionize financial systems and reshape the global economy. From faster and cheaper transactions to enhanced financial inclusion and more effective monetary policy, CBDCs offer a wide range of potential benefits. However, the development and implementation of CBDCs also raise significant challenges and concerns. Safeguarding privacy, mitigating cybersecurity risks, addressing the potential for bank disintermediation, and preventing the misuse of CBDCs for political purposes are crucial considerations. The road ahead for CBDCs is likely to be marked by both opportunities and obstacles. Central banks, policymakers, technologists, and citizens need to engage in thoughtful dialogue and collaboration to navigate the complex trade-offs involved and ensure that CBDCs are designed and implemented in a way that benefits everyone.